my uncle, who used to work for Apple, worked from 8 to 5, and he purchased multiple homes. Today, I believe he has about 30 rentals, and I love the fact that he can have passive income.
Okay.
So go ahead and get started.
So here is our agenda for today. So as we get started, I'm just curious, out of the room, who here already owns a home? Okay, so I'm guessing everyone else here is not starting yet. Okay, so first of all, what you want to consider is, what do I want to buy a home? So we think it makes sense for you to buy a home if you're going to be in the area and more stable in the area long term. So is your job stable? Is your lifestyle stable? Is the greater Seattle area a place you want to be the long term rather than short term?
The other reason for buying or purchasing a home is a lifestyle change. I purchased a home last year. For myself, I wanted to be within 15 minutes of commute to my office, kind of a little spoiled. I also play tennis, so I wanted to be close to my 2 gyms. I also enjoy paddleboarding, and I wanted to have a couple kids or a few kids, and I also wanted to be close to different schools that were really good for them.
Okay.
It's a lifestyle change.
So the primary reasons for buying a home. So you'll probably see yourself in one of these categories here. A big one that I see a lot in this area. So first of all, desire to own a home. So as a long-term wealth building tool, real estate is going to be one of your best bets. So there's a lot of tax benefits from owning a home. So there's, if you're single, you can write off up to $250,000 in capital gains. And if you're married, that's up to $500,000. And then, yeah. How you want to go?
Sure. So other reasons why people, again, is they want to move because of different areas of schools, change their family situation. So if you're living at home, you graduate from college, so a lot of times your parents, are looking to downsize, and that's one up here too. So looking maybe downsize from like a 3,000 or 4,000 square foot home into a smaller home. And here you are, you're probably in your early 20s, maybe early 30s, and you're looking for a change and you want to create independence. Owning a home is a great thing. One for one is when you get into a mortgage, and we'll talk about that a little bit later, is your mortgage is consistent for the next 30 years. Whereas if you rent, I don't know, for those who are renting, how many of you have had your rent increase in the last 1 to 5 years? Yeah. The other thing too is, like sometimes you want to customize your house. You want to change the color. You want to hang something up on the wall. You just have a lot more flexibility when you're in your home. It's a lot more stable, and you get depreciation. So desire for more space. With COVID in the last 2 years, a lot of people were in like the 1 and 2 bedrooms. So now you needed what? More space to work from home. You wanted a home gym. Restaurants were really literally closed down for a period of time. So you wanted a larger kitchen. If you had kids, you wanted a bigger backyard. And so you wanted to entertain, right? So just a few different reasons why people needed a new space. And then here's another one. In the last 5 years, who is a transplant here? Who's moved here because of a job? Yeah, quite a few of you, right? I mean, that's another big reason why people move here. And we have a great economy here. We're surrounded by all tech companies. Another part of the reason is downsizing. You move into a house and your parents are looking to, get into a smaller house, maybe get into a Rambler where they don't have to do stairs. That's another reason. Affordability. Some people hate paying rent. When you keep paying rent, let's say, for example, I own rentals. So I appreciate being a landlord myself. But let's say, for example, like you're renting out a house for $3,000 a month and someone's going to be paying $36,000 a year. I'm not a math genius, but over a period of 10 years, you're going to pay $360,000. Who's that going to? That's going towards someone else who's paying off their mortgage. I mean, when do you want to own that home? So I bought my first house in my early 20s, and now, 15, 20 years later, these properties are almost nearly paid off. And I'll explain that story a little bit later, but you also get cash flow later on. So the one thing about owning a home versus like buying stocks, nothing against stocks, stocks more long-term, and I have stocks as well. But with real estate, short-term gain is, the tax write-off and the appreciation, right? So go on to the next slide. Going back to-
So yeah, we're using this analysis here, renting versus buying over the long term. Like we said, we want to make sure that it's a good idea for you. So we're using an evaluation period of the next 7 years, as you'll see on the top left corner. And then let's give it your monthly rent's going to be $2,500. And on the flip side, we're going to use the buy method. So purchase price of 800,000, down payment being 80,000. Appreciation, we're just going to give it a moderate 5%. So net cost of renting for the next 7 years costs you 245,000. On the flip side, I mean, if you buy right now, this is your net cost. So 92,000 is out of your pocket. However, over the next 7 years, you're actually up $151,000. And this is accounting for the cost of selling your house in the future, home maintenance. I mean, that's all calculated into here. And we can always adjust these numbers and work with you individually if you have any questions.
Yeah. Owning rentals is a great way to diversify your portfolio besides just owning stocks and retirement. Because your retirement, you're not able to touch that until like in your 60s, correct? Whereas owning a home is something that is very tangible, something you live in, something you can see, you can touch, you can feel, you can entertain, you can make memories. And it's yeah, so.
Yeah. Okay, so I'm sure a lot of you guys have heard interest rate is super high right now, and that's totally the case. So today we're looking probably closer to 7%. Here's an example of a house that sold in 2020, so 2 years ago in November. So the price of this 5-bedroom, 3,000 square foot house was $970. So to buy this house back then for $1 million with a 3% interest rate, your payment's $4,150. Okay, so this is the case 2 years ago with then rates. And then today, if you buy that same house with a 7% interest rate, right? But the price has dropped 20%, so 800,000, your payment's 5,000. So that's almost $900 more that you're paying today, even at the decreased price, right? So we totally get that's a problem. On the good side, now lenders have come up with a program. It's called buy down programs, where you can buy the rate down from the seller. So you get closing costs paid for. You not only negotiate the closing cost of the house, or sorry, the purchase price of the house, but back end closing costs, and bring your rate down 2 to 3% for the next few years. So if you do 5% interest rate at the $800,000 price, your payment's $4,200. Earlier it was $4,150. So you're paying what, $70 more, but you're buying the house for $200,000 less. You're actually buying at a much lower price and building equity a lot faster than buying at the top of the market.
That's awesome, man. I love that. I love this illustration. How many people believe in second chances? This is your second chance to potentially buy, right? So it's a great illustration.
So if you decided that I think I want to buy a house, that's a good idea for me, then here are the things that we need to consider. Is your credit score? We can really work with whatever credit score you have. Down payment, where is that going to come from? So it could be in the form of a gift, it could be your stocks, it could be just money you have saved up. You also have to consider, okay, what am I comfortable with paying per month? So what the lender will look at is your debt to income ratio. So this is considering all your debts, not just your mortgage. So they don't really want to see it exceed over 43% of your monthly income.
Can you give me an example of that, Lam?
So if you make $10,000 a month, then your debt should not exceed $4,300.
And does that include everything? So that's your mortgage, your credit card, your student loans, and your car payment?
That includes everything.
Okay. Perfect.
Okay, and then you should have about 6 months of living expenses, mortgage payment, and any additional funds for home repairs, because when you're not buying new construction, you probably have you may have some work to do on the house.
Perfect.
So what are my costs? So it's going to be your down payment and your closing costs. And your closing costs, we say, is about 1 to 2% of your purchase price. And all your closing costs is your lender fees, your title fee, escrow, appraisal, prorated insurance, and property tax.
So lender fees can be up to 1% of the loan amount. So say, for example, if you purchase a home of $1 million, you take a loan of $800,000, it can be up to about $8,000, depending on if you buy the rate down. Title and escrow is typically about $1,500 to $2,000 each. Appraisal is about $1,000. HOA is only applicable if you're purchasing a condo or townhome that is in a planned community where you have covenants and restrictions. Prorated insurance, reinsurance typically ranges about $1,000 to $1,500 a year. That's all built into your mortgage. Same thing with a property tax.
So as you're searching, I mean, everyone's gonna have their needs and their criteria. So you should become very clear on what are my non-negotiables. So some examples of that is, hey, I don't want a commute of more than 30 minutes. I want at least 2 bedrooms or 3 bedrooms.
A home that's
Yeah.
completely remodeled, where I don't have to do any works whatsoever. Maybe I'm allergic to carpet and I just want all hardwood floors. Other negotiables, at least for myself, when I purchased a home last year, is like I said, I wanted to be next to all the activities I enjoy to do. I also love to eat, as you can see. And so, being next to all the restaurants and, amenities was super important to me. And that's something that we can help you with as well. Want to talk about the, okay,
What is it?
that's it, go ahead.
So home buying process consideration. Hey, first of all, is it a good idea for you? Secondly, you want to find a good real estate agent. And thankfully, you're looking at one. Thirdly, we'll introduce you to a lender and start your pre-approval process. So that's really one of the biggest factors in the home buying process is.
Why is it important to find a good real estate agent, Lan, when everybody can look online to find a home themselves?
There's a lot of information that's not on Redfin, Zillow that we can educate you on. So it's local expertise. Maybe it's just knowing what are the best areas to be in, what are the best neighborhoods within the school district that you want to be in. We're going to make sure that you're not buying the wrong house, because the wrong house could become more of a liability rather than an asset. So for example, if you're looking at Kirkland, we as agents know that along 124th, 116, there's some power lines that you should probably avoid.
Yeah, we're like a second eye or a magnifying glass, as you could probably, I guess, just, we're like a magnifying glass to your home search. So looking at, here's the one thing is, if you've never purchased a home before, looking at a roof, do you know how many years left there is on a roof? We can actually tell you that. Do you know what type of siding is on the house? Is it LP? So LP stands for Louisiana Pacific Siding. That is a compressed wood, where if it has any type of wood or water on it or so forth, the axle material will actually break apart. Understanding the different furnaces, hot water tanks. So there could potentially be a lot of deferred maintenance on a house. So that's something that we will teach and educate you on. And then also introducing you to the right lenders so that you do get a good loan for your current situation. And then, like Lan had mentioned, power lines, retention ponds, being next to busy streets. These are things you want to avoid because that will affect your long-term appreciation.
Okay. We'll now talk about the pre-approval process. Yeah.
Am I good?
Can you hear me okay? So I'm Katie Reichling and Jim Reichling, and we're brother-sister team. We work at been in the mortgage industry for 20 years. And we're here to answer questions. I did want to piggyback on a couple things Lan had mentioned. 43% for your debt ratio is a number that is used very frequently. We can at times go as high as 45, 50, and 56. So when you talk about the lender introduction, you want to work with lenders who know all the differences in all the loan programs, how much is required to observe, how much of your income can be used towards qualifying. Sometimes you can use all income, and sometimes we can go a little higher. So that's why, we love working with this team. They're very experienced and they know how to find how to choose a good lender, and hopefully that's us. Anyway, we'll talk about pre-approval and I'll talk for a little bit.
Yeah, so you'll get started. You'll reach out to Hao or Lan or somebody on Hao's team wanting to start searching for a home, and they'll point you to our direction to get pre-approved. So they'll do an introduction by email or text or phone, whatever you prefer. And then we'll take it from there, start the process. We'll go through any questions you have on getting pre-approved and what loan options there are, any other questions you might have. And then we'll get you started with the application and gathering your financial documents. Typically, a pre-approval will take about 24 hours. If you're self-employed or you have other circumstances, everybody's scenario is a little bit different. It can take a little bit longer.
When we're working on the pre-approval, one of the things we're talking with you about is also your wealth, because as Lan and Hao were saying, real estate, especially for young people starting out, they don't a lot of times have a big pot of money. So it's a really, really powerful way for you to increase your personal wealth. And so we're going to talk to you about kind of what your plans are now, where you think you'll be in 2, 5, 10 years, to help you determine what kind of loan is best suited for your situation. We're going to ask for permission to pull your credit, and we're going to ask for some information on your income and your assets. Our team tends to be, there's different ways of going about a pre-approval. Our team tends to be very focused on the upfront part. We want to make sure that you are 100% prepared to make a very strong offer. We don't ask for anything that anybody wouldn't ask for, but we ask for more upfront. So then you can just relax, go shopping, know that your pre-approval is very solid, and make an offer whenever you're ready. And then we'll send a pre-approval letter out to you and your agent, and we'll talk to the listing agent and help you get your offer accepted.
Yeah, and we'll also ask you questions like what price point are you looking for? What kind of down payment you have? And then one of the questions we like to ask is, what is the monthly payment you feel you can afford? Because oftentimes people will say, I'm at home around 700,000, but they want a payment around 2,500. Well, those two don't work. There's no real magic to the numbers. So that's why we like to ask both those questions, because if you're telling me within your budget, you can afford around 2,500 per month, that might be a $400,000 purchase price or loan amount in that range. So these are different loan types here. The first one is FHA. FHA, if you have less than a 20% down payment, conventional is also an option, and we'll get to that. But FHA may be an option to consider for you. They are 3.5% down as a minimum down payment. They also will allow lower credit scores, but the downside to FHA is it has 2 types of mortgage insurance. It has upfront mortgage insurance, which is financed. So you add that to the base loan amount, and then it has monthly mortgage insurance. The monthly mortgage insurance with FHA is permanent for the life of the loan. So as long as you hold that loan, you will pay that mortgage insurance. Over 2-3 years in this market we're in, you'll probably have enough equity, 20% or more, where you can refinance out of FHA into conventional and get rid of that mortgage insurance.
So conventional loans, usually, I would say 80% of our clients get conventional loans. But the one thing to watch out for that we pay very close attention to is your credit score, because as it says here, if you're below 680 on your credit score, a lot of times the interest rate and the payment and the mortgage insurance will be far more appealing if you do an FHA loan, because mortgage insurance, the private mortgage insurance, can become expensive below 680. But if you do a conventional loan, the mortgage insurance is not permanent. You can get it removed once you reach that equity and time period requirements for the mortgage insurance. But you can put 3, 5, 10, 20, whatever percent down, but the minimum is 3% down. So you can put potentially less down on a conventional loan.
And then VA loans, this is one of my favorite types of loan products. If you're a veteran and you have veteran benefits, then you most likely would qualify for a VA loan. As it says here, it has flexible debt to income ratios. So with certain positive aspects of your file, like a higher credit score, maybe even a little bit of down payment. One of the nice things about FHA or VA is you don't have to do a down payment. You can finance 100% of the purchase price. But if you do have a down payment, it will lower the VA funding fee. The VA funding fee is their type of mortgage insurance. So right now, if you do 100% financing and you're a first-time user, right off the top of my head, it changed recently, is 3.3%, I believe. And if you're a multiple time user, it's 3.6%. If you do 5% down, it's 1.5%. And if you do 10% down, I believe it's 1.25%. Again, these recently changed, so I don't have them memorized, but I believe that's accurate. So there's benefits to doing down payment with it. But we have had people at 64% debt to income ratio. One of the things VA looks at is residual income. So beyond all your minimum debts that you have on your credit report and the proposed mortgage payment, they look at what's left over. And the higher the residual, the higher they will allow you to go with a debt to income ratio. Damage credit, again, we can go, down as low as 580 with VA. So if credit is an issue, we can usually work with you on that as well.
And then the last loan type here is jumbos, and that's where you get into very specific scenarios. We have, I don't know, 15 different jumbo lenders, and there are going to be some standards that are very similar, but they will differ based on permanent residency, amount of months of reserves, credit score, down payment. This is where, when Lam was talking about 43%, you guys are probably more in the jumbo area, in the Bellevue area. You're going to be more strictly at 43%, sometimes even 41. But we do have a 10% down jumbo. Rate's going to be even worse than it already is worse, but it's an option. But we have a team and we're trained. We know all of our jumbo products very well, and we will be looking at each jumbo product to see which one is the best fit for you, and then talk to you about the options, and then ultimately you decide which one makes the most sense. But we'll try to give you the right guidance so you can make the best decision.
Can you explain the difference between a conventional loan and jumbo loan with us?
Oh, for sure. Yeah, that's a very good question, Hal. Thank you.
So on conventional loans, there's two important loan thresholds. One is a standard conforming, and right now that is at 647,200. And we just got word that it's going to change. We don't have the exact amount, but it's going to be somewhere around 725. And then in the Tri-County area, which is Pierce, King, and Snohomish County, there's a high cost, we call it a high balance loan limit, and that is anywhere over 647,200 up to 891,250. And again, that high balance limit is going to change at the new year, and it's expected to be over $1 million. So we're hearing like 1,025,000, something like that. So those two thresholds, you are a standard Fannie Mae Freddie Mac conforming loan. Anything over 891,250, you are jumbo. And jumbo is where these products fall into.
Just as a side note, though, we do have some jumbo products that go down to 647.
We do have some jumbo that will cover the high balance area, because every county outside of King, Pierce, and Snohomish, that is a jumbo loan. So we have some lenders that will cover that within the Tri-County area.
Anybody have any loan questions? We've thrown a lot of information at you.
On the right side of the screen there, that's kind of a summary of what we just talked about. You got FHA with a credit score down to 580, 3.5% down. Conventional down to 620. But again, if you're below 680, as Katie mentioned, you'd probably want to consider FHA. VA again will go down to 580, 0% down, so 100% financing. And that funding fee I mentioned, that also can be added into the loan. So you can essentially, in this market especially, get in with zero money out of your pocket with no down payment and seller paid closing costs. So that's a great option as well. And then the jumbo, 680, 3.5% down. But there's going to be a huge difference in rate as far as improvement if you're up above 700, and then it runs in 20-point increments above that. So anything above 720, 740, or anything above 760, that's going to be top tier. And if you do more than 20% down as well, you'll get the best product out there for jumbo.
Yeah, that's a very good question. So we do things. Oh, I'm sorry. How long is a pre-approval good for? You asked. So what we do, we pull your credit. That's technically good for 120 days. However, we have to close within that 120 days. So if you find a property at day 100, we're going to probably have to pull your credit again. If you don't find a property within that 120 days, we're not going to automatically pull your credit. We have already done all the hard work and all the heavy lifting for your pre-approval. So we're just going to sit and wait. And if you call us 6 months and you say, hey, Jim, hey, Katie, I found the perfect house, I need a pre-approval letter, we're going to ask you if anything's changed. And then we're going to ask you if we can pull your credit. And then we should be able to issue a pre-approval letter really quick, maybe with some updated pay stubs. Okay. So it's about 3 months, 3 to 4 months, but we don't, but it's technically 3 to 4 months, but we kind of massage it a little bit and go out a little longer if we can.
Is there any other questions? Yeah. So as far as the credit goes, yeah, so the question is, if we have to repull credit, it is another hard pull. And yes, that is the cost of getting pre-approved is to pull your credit. Now, pulling it once is not going to affect your score. What affects your score is multiple inquiries into your credit. So if you're looking at buying a car and you pull out a credit card at Macy's to save 10%, and then you call us and you want to buy a house, well, there's going to be 3 inquiries on your credit report. And yes, that's going to affect the score. But just that one pull. And then the other thing to know is inquiries fall off over time. They affect your score less and less the older they get. So don't let a hard pull on your credit scare you away from getting pre-approved, because the bottom line is it's essential to do it to get that approval. So just don't have it pulled multiple times.
And also, we've been doing this for 20 years, so I would never recommend somebody go to a credit repair company unless there's something legal that needs to be taken care of. But we know how to help you with your credit. So we can tell you, hey, you're at 680. We want you to be at 700 for this jumbo program. Here's what we think you should do. And we can help you, guide you, and help you get your credit score higher. And I think that that's an advantage to working with people that have some experience, because we do know what to do.
Any other questions? Okay, thank you.
Oh, Kim.
Yeah. So government loans are considered FHA and VA. And yes, they typically run about 0.25% below a conventional loan. So they are a little bit lower. Having said that, all rates right now are high. So, the projection for interest rates, while I'm talking about interest rates, is in 6 to 12 months that we're going to be somewhere in maybe in the high 4s. But I wouldn't wait to buy until then, because this is a great time without the competition, and you can always refinance in that 6 to 12 month period and get that lower interest rate without competition. Because I can tell you 8 months ago, it was 2 years ago, Hao and Lan can attest to that. It was crazy as far as competition goes. And I think when interest rates come back down mid 2023 to the end of 2023, we're going to be right back there again.
So even though rates are higher, people are saving 50 to 100,000 plus buying a house now
without having to escalate their offer price just to basically win the house.
Getting seller paid contributions.
Yeah. Yes.
Talk with us first. Yep. Because we may prefer that you have cash in your checking account versus no credit card debt.
Yes. Not that they would. So the question is, would the seller pay the closing costs? That would be part of the negotiation, asking the seller to pay closing costs. And that's where Hao Lan or somebody on their team would help you in negotiating the price of that home and trying to get those closing costs paid for. But if the seller is not willing to pay the closing costs, then you as the buyer are responsible for that. And typically, an average closing cost depends on the price of the home and the property taxes, et cetera, but you're probably going to fall between $8,000 and $10,000, $11,000 for closing costs and prepaids.
Now's the time to get a seller to pay, because they wouldn't have paid 8 months ago.
The question is, can you negotiate selling costs on a conventional loan? Closing costs, yeah. And the answer is yes. Yes, you can. Correct. Any one of these programs, and Hao and Lan can talk more about this as well. But yes, you can. That's all part of their negotiation and their conversations with you as a buyer. Okay. Oh.
No.
What was the question?
Oh, do you have to wait for a specific time before you can finance a house? I mean, or refinance?
6 months.
Yeah, 6 months.
So I'll give you an example of a deal we did last week. It was a house listed for 700,000. It was originally listed closer to 780. So we saw the price come down on that, waited till it was 700,000. And then instead of going 680 or 650 on the price, we asked for $20,000 in closing costs instead. So it didn't matter if it was a VA or conventional loan, it was, we wanted that the closing costs paid for and get your closing costs paid for, so that you can actually, your monthly payment is significantly lower, so 2 points in interest lower, which is a massive difference in your monthly payment.
Add on to what Lan had said is, now compared to 6 months ago, we can negotiate price, which is a big thing to buyers. But more importantly, we can get your closing costs paid for. If you're in a lease, we can get your lease paid for. So I have one example where I have a client that their lease is not up until next March. And I said, well, let's do this. Let's go ahead and get you pre-approved. It's going to probably take you 30 to 60 days to find a house, so take your time. So let's say 60 days. So now we're in, let's say January. Okay. And so it's going to take about 30 days to close. So we're basically end of January now. You have 2 months left. We can get the seller to pay off your lease. So in this case, in his current situation, he's paying $3,000 a month. We'll get the seller to contribute. Let's say the house is 800,000. We'll maybe get the seller to pay, let's say $15,000 in closing costs over all his fees, his prepaids and so forth. Break the lease, and then also pay for all his closing costs as well and negotiate the price. So it's a good time to be a buyer right now. So because you are able to see the home multiple times, you're able to negotiate the inspection, and I think that's covering up in there. And you're able to basically get in and just come in just with your down payment. So it's a beautiful thing right now.
So that's what the home buying process looks like so far. Number 4, we're going to want to narrow down our search. So once you have that pre-approval, we'll have an exact budget in mind. So that's when we can actually go into them. We'll talk about your non-negotiables in the house. What are the things you absolutely need versus what maybe you want. And then we'll narrow down our search and then we'll go visit those homes in person. That's when we'll be able to educate you more on, hey, you're on this type of street, you're on this zip code, this school district. This house has 10 years left on the roof because it's a composite roof, or this has LP siding or hardy board siding. So that's where you'll get educated on the actual home itself. And then hopefully we find something good for you. We'll submit the offer. We'll do all the negotiations. And then your offer gets accepted. Congratulations, you're officially under contract. So when you look on Zillow, Redfin, and it says pending, this is the stage that they're talking about. And this is when you lock in your rate. So although you see on the news, hey, the rate today, blah, 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 you don't actually lock in the rate until you're under contract. And then we'll do the inspection. So the inspection's about $600, $700. We'll hire a professional inspector to come through, check out everything in the house, so all the exterior, the crawl space, attic, appliances, electrical and plumbing, make sure everything checks out all right. If we need to, after the inspection, is renegotiate on the deal. So let's say about $5,000 worth of work comes up that we can ask for additional closing costs or bring the purchase price down. And then you'll also deposit your earnest money. So the earnest money is pretty much like a deposit, or it's like a security deposit on your rent. But this is money that just gets applied towards your down payment later. So you're not paying a penny over. And then this is typically about 2 to 5% of your purchase price. We'll also do a title and resale certificate review. So title is making sure that the seller, if they tied up the home in any liens or loans, that gets all cleared away. You may have heard like horror stories of people buying a house and there happens to be a lien that didn't get cleared away. In Washington State, you'll have free and clear title. And then you'll order the appraisal. This is to protect the lender, make sure that they're not over or giving you too much money or that you're borrowing too much money for the house.
I've always said, we're not just real estate agents. We're like your tour guide and we're matchmakers. We help you or the consumer, the buyer, fall in love with the home just as much as the home is going to fall in love with you. So every aspect of the home is like part of your personality, right? So like if you love to cook and you love to entertain, you'll find a home that has a really nice kitchen. If you like to spend time in the backyard, like if you like to meditate and so forth, you'll find a home that's peaceful and quiet and tranquil. if you work from home and you want peace and quiet, like if you don't go in the office and you do work from home, like this is your time to go find that perfect house where you can actually focus, concentrate, and do all of your creativity in your house, you know? And so like in my house, you know, I love to work out. Like I have a home gym, I have a home office. And so you're trying to find that perfect house that matches you. I was gonna say, like, yeah, so
Yeah. So let's get that home gym for you guys. Final walkthrough 1 week prior to closing. So 1 week prior to closing, we're gonna go back to the house, make sure everything looks just the way we found it. So all the staging is out, you know, if there's been any damages done to the house, it's pretty much to make sure that the house is the same condition as when you first saw it. And then you're gonna go to the escrow office, that's where you're gonna wire your funds to close on the house. And then on the day of closing, you get your keys and you're happy homeowners. So here's some common myths that we've seen here in the marketplace is that you need to put at least 20% down. As we talked about, that's definitely not the case.
compared to like a few months ago, right? Or even the last 2 years, where you're putting 20% down and you're putting big down payments. Nowadays, like you can actually get into home, look at the home multiple times, come in with less down payment, you know, have a financing contingency in there, have an inspection, and have the seller fix everything on the house, or at least negotiate some money back, which is a great and beautiful thing. So yeah, I just wanted to add a little bit more to that.
How you want to talk about number 2?
Sure. So, you know, everyone says fall and winter are bad times to buy. I can tell you right now, I purchased a home back in 2010. You know, everyone says it's bad to buy in October, November. Honestly, I found a home that was on the market for a little while in downtown Bellevue. At the time, that was in a downturn. Neighbor bought his house for $950. I got my house, guess how much? For $580. 4 bedrooms, 3 baths, just a little bit over 2,000 square feet for $580. Great investment. Bought it in November. Nobody else at the time was looking. It was raining, it was cloudy, it was wet out. I was like, wow, no one's looking at this house. It's the perfect time to buy. So although there's less competition in the marketplace compared to spring and summertime, things don't look as good, but I'm okay because I can oversee that. I can see that the home is in good shape. It's a great location. First step, you want to go into first steps in touring homes?
Yeah, I mean, the first thing you should do is speak to the lender to get pre-approval. Before looking at the home, you want to make sure that what you're looking at is, you know, within reach.
Student debt must be paid off before buying a house. That's a misnomer. You don't need to pay off your loan. Good thing, you know, it's okay to have debt, right? As long as, I mean, sometimes unless the debt's really high, but you don't need to pay off your student loan prior to owning a home. And in actuality, it's not bad to actually buy a house. And sometimes I've seen this with a client of mine, is to own a home for a number of years, and they will either take a line of credit out or refinance and pay off that student loan that has a higher interest rate. Buying a home is out of reach. You know, when I bought my first home back in 2002, I was a software developer, and I was like, can I buy this house? Really? You know, it was $272,000 for my mom. I was like, it is kind of high. Do I want to pay $2,500 a month? You know, at the time, let's say we were renting for $1,800. If I save a little bit of money, I can purchase this home. You know, some of the benefits, like I said, is you get depreciation, and that home today is about $900,000. It's paid off like a number of years ago, 10 years ago. My mom still lives in the house. You know, if I didn't make that decision back in 2002 for my family, we would not be in the situation that we're in today, where she lives in a house today. She has like 3 roommates, and she rents each room for $700. So she, you know, it's cash flowing for her, $2,100. It's great money for her to live off, and she has roommates to stay with. So never think a home is out of reach. You know, just try to get what the max that you can afford. There's 3 things that you can write off. You can write off for your student loan. You can write off the interest on your home, and if you have a business, you can write that off as well. So, I mean, take advantage of the tax breaks. So yeah.
Okay. So yeah, this is just another you know, a reminder as to why the difference between buying in today's market versus a year or 2 ago is you definitely have a lot more choices. You can look at the house for more than 15 seconds, right? You don't need as much of a down payment. You're gonna have all your contingencies intact, so you'll have your inspection, financing, appraisal, and we can get into that all later. You're gonna have less competition. If anything, the home has no other offers, so you're bringing the price down. And the thing is, you can always refinance the loan later, but you can never buy the house for less. All right?
What we're telling people is date the interest rate, marry the home. Like I said, you're gonna have less competition today in today's market for the next 3 or 4 months. And one thing is, if you participate as a buyer, if you're selling the today's market, we always recommend either one, you can buy a contingent, so you can sell your home. You can make an offer on a home and then sell your home afterwards. There's a few different options. You can also take the equity out of your home, purchase the new home and then sell your home later, and or keep your home as an investment property and then buy the next home with the equity that's in your house. So we can talk through that. The one thing that's good about our team is we're very knowledgeable about everything on the house. So typically what we're looking for is, the least amount of deferred maintenance on the house. So just remember that. So we're trying to get you into a house that is not a lemon. So a home that's more certified. It's all ready to go, move-in ready. So you don't really have to worry about anything in the future. Payment arrears. The great thing about, so let's say, for example, going back to that first example, is if you purchased a home in January, if you closed in February, you skip March 1st, your first mortgage payment is April 1st. So you can actually save a little bit of money while you're purchasing a home if you're currently renting too, depending if you can work out the time frame. We're talking about negotiations.
So I think we've covered it. The
Payment
arrears.
arrears. Yeah, so based on the information that you give us, let's say, for example, your lease is not up until April, we could kind of time it so that, let's say, for example, we find a house for you in January, we would close on it in February, and then your first mortgage payment, you skip the next month, your first mortgage payment would be April 1st. Yeah. Yeah, so so we could time it so that you wouldn't have any overlapping payments. Yeah. So I'm sorry, one other thing too is, if we need to, in the beginning, maybe we're not going out as often, maybe once a week or so forth, once every week, once every other week, depending on how much inventory is out there. As we get a little bit closer, that's when we want to be more aggressive. I'm looking for a home.
Okay.
Oh, no, this, okay.
So
Finalizing alone, yeah. There's a little bit of information, I think, back couple, right there. So some of these abbreviations you guys won't know because this is part of our process with our team. I'll talk about the first part and then talk about the second one. But when we're going through the process, it's a big process. It's expensive. It's scary. You feel like you're just putting money all over the place. So what we do is there's a closing disclosure that comes out, and it has to come out at least 3 days before you sign your closing documents. And it's kind of a quiet period for you. And we will go over this information with you, and it will itemize all the details of your transaction, everything in there, all the costs, expenses, anything the seller's contributing will be in the closing disclosure. And it's a legal document, and you have to acknowledge receipt before we can proceed. And so it's actually one of the new laws that came out probably 8 years ago after the mortgage meltdown. And there were so many laws that came out that we didn't like, but this was one of the good ones because it really did force the lenders to slow down and give you all the information in enough time to ask good questions.
So the PCC, that stands for pre-closing checklist. And this is something that we do on our team as an additional service to the buyers that we work with, because going in to sign the closing papers can be kind of a scary process. So the pre-closing checklist, we give you a call before you go in to sign your papers, and we kind of go through the final numbers, what the total cash to close looks like, what the interest rate is, what your monthly payment is. If you're paying off debt to qualify, that's another thing that we can do. Then how much is that extra? So there's a bunch of numbers that go into that, and we just make sure that you're aware of them, you're comfortable with them, it's what you expected. and then answer any questions that you have. It's kind of a final touch that we do. I mean, we'll talk to you on closing day, et cetera, but it's kind of the final touch that we do just before you go in to sign those papers.
And part of that, all of that is we give you the contact information. You should have it, but you may not. There's so much going on. So we'll repeat the contact information for escrow and let you know where to, who to call, so you know where to send your money for closing, because one of the things that happens these days sometimes is wire fraud. And so we want to make sure, and we help babysit you with that, make sure that you're wiring the money to the right place and not some fraud's not occurring. It has never happened to us, but we have heard stories. So we'll talk with you about wiring your money and where it has to go and who to contact and how much. And then we go through on the PCC, we're going through really basic stuff. We're like, okay, your purchase price is $575, right? Just want to make sure everything is exactly right before you get down to those closing papers.
Mhm. And then signing the final papers is just that. You're going in on signing day. That is not closing day. That's a popular question I get, but you are signing the final papers for closing. It's the deed of trust. It's a promissory note, the promise to repay. And then there's a bunch of government forms that actually are meant to protect you as the consumer. Overall, it's about a half-inch stack of papers, and it takes about 30 to 45 minutes to sign. Once you sign, then those papers go back to our funder for review, make sure a signature or date wasn't missed. Sometimes there's letters of explanation that we ask for, the underwriter will ask for, make sure those are signed and everything's in order for the day of funding. And then that's when you would work out the final walkthrough with Hao or somebody on Hao's team to make sure that the house is ready for closing. And then on closing day, you'd send the wire directly to escrow. And that's when we call you as the buyer and the agent, your selling agent with Hao, and then the listing agent as well. Let everybody know that we've sent the wire. So from the lending standpoint, we're all done. And then in order to be technically closed, escrow has to get the recording numbers from the county. That always happens same day, usually mid-afternoon. And then once those recording numbers come in, you can pick up the keys from your agent. So these are some tips for financing options in today's market. The most popular one that has been gaining a lot of traction, it's always been around, but with rising interest rates, is the 2-1 buy down. And that has to be seller paid. And the reason is buyer, it makes no sense for somebody to prepay their own interest. So on a 2-1 buy down, how that works, let's say your interest rate, the note rate is 7% today for 30-year fixed. Then the first year, your interest rate is going to be 5% and your monthly payment is going to be based on that 5% rate. The second year, it's going to jump up to 6%. And that's going to be your new payment for that second year. And the third year is going to be the 7% for the remaining 27 years of the loan. So the difference in payment between 5% for 12 months, let's say it was $800. So that's what $9,600. And then, so that is the cost for the first year buy down. And then the second year, maybe it's half of that, $400. So you're adding another 30 or 4,800 on top of that. So you're asking for the seller for about $14,000 in closing costs to pay for that buy down. Again, it has to be paid by the seller. And then if you can negotiate additional closing costs, that's great. But that's the 2-1 buy down.
And the 80-10-10 is actually 10% down on the most common loan in the country. It's a conventional loan. And what happens is if you put less than 20% down on a conventional loan, you have the private mortgage insurance, which we discussed a little earlier. And a way to get around that is with using a 10% down, and then you get a 10% line of credit, and then you get an 80% first mortgage. And we would do both the first and the second. First mortgage would be 80% of the purchase price. Second mortgage would be 10% of the purchase price. The second mortgage is always line of credit, which is a variable interest rate. And then the 80% would be whatever kind of loan we pick for you, whether it's an ARM or a 30-year fixed or 15-year fixed, like that. So you would just then at that point come in with 10% down. But with an 80-10-10, you do not have the private mortgage insurance. So what we do is we balance all of your whole situation because we do have 90% loans where you put 10% down. And then you pay the PMI. So we want to look at both the 90% option and the 80-10-10 to see which one costs you the most. Because if you have really good credit and you put 10% down, I've seen private mortgage insurance be as low as $40 a month. So that, and with the appreciations in this area, you may only have that 12 months. So that's $500, right? So if you did an 80-10-10, the HELOC interest rate is going to be higher. And right now, when the Fed raises rates, that's the interest rate that's going up. So we want to balance that with a little bit of more risk with the 90%, but 10% down is the most common loan in this country.
As far as seller paid items, we touched on throughout this conversation on closing costs and negotiating that. The rate buy down, which is a 2-1 buy down, or it could also be applied towards paying discount points just to buy your initial fixed rate a little bit lower. So if today's rate 7% and the seller was willing to pay closing costs plus some of the buy down, you might be able to get 3/8 lower in rate for a point cost. And 1 point is 1% of the loan amount. So if you're borrowing 700,000 and you buy the rate down, pay a point, you're paying $7,000 plus the closing costs on your prepaid items. But if the seller can pay that, then that's great, because hopefully then in 6 to 12 months, we're refinancing you anyways. And then the repairs from your inspection can be negotiated. Improvements, typically you're gonna do that on your own outside of closing. Yes.
So what's the benefits of financing?
Yeah, so the question is the benefit of the 2-1 buy down. Well, first off, the seller's paying for it because they have to. So you're saving money on the first year by having your start rate at 5% and then 6% the second year. And so that's benefit right there. You could buy, like I said, pay it, from 7% down to 6 5/8, and that's your 30-year fixed. But I guess the real benefit is knowing in the back of our mind that we're going to refinance you in 6 to 12 months. If you buy in this high interest rate market, that the rate buy down is a one-time sunk cost. You lose that money, whether it's you paying it or the seller, that money's gone. On a 2-1 buy down, that's prepaid interest. So if you refinance 8 months from now into your first year, then whatever interest is left on that buy down, that 16 months that's left, that interest remains and it is deducted from your payoff, lowering the amount of the payoff when you refinance. So that money is not lost. So that's a big benefit right there.
And that is actually something particular to Homebridge. Lenders do not have to give you that money back, but Homebridge does. They give you that money back. So it's like the seller giving you a lower price on your house,
Yeah. Sure. So the question is, what's the difference between 2-1 buy down and the rate buy down? Correct. Yes, it has to be paid by the seller. And that's the advantage. The difference between these is you got a lower start rate. So your payment's going to be lower for the first and second year. And then if we're refinancing you, that's where the benefit lies in that one versus a rate buy down again, because a rate buy down, it would be an astronomical cost for you to go from 7% and buy it all the way down to 5%. And then if there is an opportunity in 6 to 12 months to go to 4.5%, nobody knows how low we're going to go. But, the speculation is 5 to 4.5% by the end of 2023. And if we were to refinance you below the 5% that you paid tens of thousands of dollars to get, that's money that's lost. So how interest rates work, you have a par interest rate. Par interest rate is 0 cost to buy it down and 0 rebate. Let's say the par rate today is 7%. And if we went above par, you get into what's called rebate pricing. Rebate pricing is a credit. So the higher you go above par, the more of a credit there is to the buyer. And we pass that along to the buyer to help pay for closing costs and prepaids. Now, if you were to go below par, that is a rate buy down. It's called discount points. They are a tax deduction. So that's one benefit of paying discount points. But the lower you go below par, the more expensive that interest rate becomes.
It's like a premium. You're paying a premium to get a lower rate.
Rate buy down, it's gonna cost you, let's give it almost 4 times as much than if you were to do a 2-1 buy down. A
Mhm.
2-1 buy down basically gives you time to refinance later at a later date. And should you refinance within the first year, that money that the seller paid for will now come back to you as form of like principal.
Yep, that's a sunk cost.
The lowers are great, 7%.
So what we're telling people right now, if the seller's not going to participate in a 2-1 buy down, we are not recommending paying points to buy the interest rate down because we're going to get there in 6 to 12 months without you paying points. Now, there are the costs of a refinance, which typically, if an appraisal is not required, then it's about $3,500. If an appraisal is required, it's about $4,200, $4,300 to refinance. But if you pay points right now on your own to buy that rate down, and then in 12 months, we can get you even lower than what you bought the rate down, you lost that money. You're not getting that money back. So you're throwing good money after bad.
So if you're like at 7% and your payment's $1,000, you buy the rate down to 6.875 and you pay $3,000 for it and you save $50 a month. So we take 3,000 divided by 50 and you get 600 months, right? And then, so that's 60 months. So that's 5 years to pay yourself back. That's what you're paying yourself back, $50 a month every month towards that $3,000 investment to get the lower rate. If you refinance in 8 months, you've only paid what? $400, right? So you've lost the rest of the $3,000 has just gone away. You've just thrown that.
Yeah.
You should have just saved that money for the refinance.
Or a par rate, because we're going to get you there in 12 months, 6 to 12 months. Yeah.
Whereas if you did a rate.
Yes, yes, yes. Yes. So the question is, if you're representing a seller, under what circumstances would you recommend the seller to do the 2-1 buy down or accept that cost of the 2-1 buy down?
So for us, like, if I'm representing a seller, and let's say the house is listed for $1 million, the difference of the buyer negotiating, like, let's say $50,000 off, and or if the other buyer that's representing the agent wants to help the buyer purchase the home, mortgage payment for the first 2 years, of course, we're going to help them. So let's say, for example, let's use 20,000. It's not. Why? Because we want to work, right? I mean, that's what mutual acceptance. You're trying to get both parties to mutually agree to all the different terms. Whether absolutely. Well, the difference between someone like coming down $20,000 in price, or the other agent who's representing the buyer asking for $20,000 to help the buyer reduce their payments. It's done. We just want to make it work. Because in today's market, like if a home's sitting on the market for 30 or 40 days, I mean, we're just trying to get all parties to agree to all terms. Yeah.
That's
So-
why these are popular now, is because 8 months ago, it wouldn't have worked.
Yeah, we couldn't do this in the market like 5, 6 months ago, even all the way up to 2 years. Buyers today are very fortunate. Like I said, they can look at homes multiple times. We can get the rates down to almost what they were before. If we we're at 7% today in today's market, we do a 3-2-1 down buy down. Let's say it costs like 25 or 30,000. We'd more than happy to give you 25 or 30,000 because we're going to reduce the price down to like 970 anyways, right? It's the same difference to the seller. So I don't know. Does that answer your question, kind of? There has to be some motivation from the seller to make it work as well.
Are you talking in regards to an inspection? Like, yep.
Here's another way of looking at it. Let's say, for example, Amazon hires you. So Amazon hires you and says, I'll give you $180,000 as a base. Okay. And I'll give you X amount depending on how things go. And I'll give you $50,000 for RSU. Or, hey, I will give you $210,000 as your base. And let's see how well you perform this next year. And then potentially RSU could be a little bit more. It's all about how you negotiate the terms. Is that
Oh, I see. He's asking if you can take the seller cost and just
So-
reduce the price.
The question is, can you take the benefit of a buy down and instead of using it for the buy down, the price of the home?
Yeah.
So that's. Mhm. Mhm. There's a rule of thumb that I like to use, and that is for every $1,000 finance, that's $5 on your monthly payment. So if you're getting $10,000 from the seller or 10,000 lower on the price of the home, 10,000 lower on the price of the home. If I'm like looking at $50 a month savings for $10,000 in my pocket because the seller's going to pay my closing costs and take the $10,000 every single time. So it's more benefit to you as the buyer to take any kind of concession that the seller is willing to give towards your closing costs at the time instead of reducing the price.
Sorry. Let me paint another picture for you. Let's say $1 million. If we just reduce the price by like $20,000, that's amortized over 30 years. How much money do you think you would save per month? Not very much money. Now, if you were to take the $20,000 and take that from the seller today and reduce your interest rate from 7% to let's say 4 or 5%, and you're saving $800 in today, like every single month, what's more beneficial to you? Money or pennies?
Well, the chances are you're not going to keep that
Yeah,
mortgage.
you're
for
not going to
30
keep that
years.
loan for 30 years.
People
So that
keep it
money
5 to 7.
today
Yeah.
is going to be more of value, like that money or that concession from the seller to get that 2-1 buy down. Yeah, it allows you to get in at a much lower entry payment than like if you were to go in at 7%. That payment's really high, not high,
Yeah.
but it's
And if you-
higher.
And if you do the math better than I did before, you save $50 a month and you keep the loan for 5 years, right? That's $3,000. But if you're getting $10,000 in cash right now, that is more
Yeah.
money because.
I'm happy to Zoom with you and I'll show you. Yeah.
You
Yeah.
can.
You definitely can do that. Yeah.
And we can get your, 2 miles.
Best of both worlds. Yeah. As
Can you
for-
repeat that? There
Yeah.
are, yeah,
Yeah. So the question is, as a first-time home buyer, what kind of first-time home buyer programs are an option? So if you don't have a down payment, then really first-time home buyer is somebody who hasn't owned a home in the last 3 years. That's technically the definition of a first-time home buyer. If you don't have a down payment, then yes, there are some beneficial programs for you, such as down payment assistance and government assistance programs, which to use to get into a home if you don't have the down payment. If you have a down payment, minimum down 3% conventional or 3.5 FHA or 0 VA, you're always going to get a better program by coming in with your own down payment. So first-time home buyer programs exist, but as a first-time home buyer yourself, if you have your own down payment, you're going to benefit by getting a standard conventional or other type of loan product.
but that's what we're gonna do for you. We're gonna sit down and look at your whole picture and talk to you about each different loan that's available to you, and then you can ultimately decide which one works best for you. So the question is the rate lower with the down payment assistance, first time home buyer? And it is not, it's higher. For the interest rate. No, there is not.
Yeah, no.
There's not. You can do that.
Yes.
Can you do a 401k withdrawal? And yes. Mhm. Yes. Yes.
During COVID, you could tap into your 401k up to $100,000, but I believe that it's back to the standard $50,000 without any penalties. So you can borrow from yourself and pay it back. You can liquidate your 401k to buy a home, but then there's different tax penalties and you can do a
Yes.
loan
Yes.
and you can do a lump sum. Yeah.
Yes. Yes, you can. Yes.
Correct.
Yeah, you can take a 401k hardship withdrawal as long as your 401k administrator allows it.
Every administrator is a little different. So check in. Okay.
Yeah.
Yes, you can do that then.
Yep. Nope. No conditions on how much money. you
If
have
it's
in
a
your bank
if it's a
account.
jumbo, we need to see and jumbo investors will vary. It's called reserves, which is leftover cash in your accounts, and it can be a 401k, it can be an IRA, stocks, other investments. But for jumbo loans, you typically have to have 12 months of reserves. Some are a little bit lower and some are higher, as much as 24 months. So you do have to have some leftover cash if you're borrowing jumbo money.
So I would suggest that what you do before you move money, before you buy a car, before you pay off any debt, don't make assumptions about your qualification. Talk to us first, because there are many times when we tell people not to pay off a credit card until after closing, because it's better for them to have that $5,000 in their savings account. We tell them not to go buy a car, not to buy a washing machine. We tell them not to move their money out of their 401k because we need it for another reason. And so there's just so many different ways to structure a loan that I highly recommend before you do make any decisions about your money and where you're going to move it or what you're going to pay off, that you talk to us first. And we can, within 24 hours, give you a plan. So it's not like you have to wait a long time to make a decision. So what's the tax you'd have to pay if you sold a home and moved out of the country? That is entirely dependent on your tax bracket, how long you've owned the home, if you're married or single. You really need to talk to a tax.
And there are some stipulations as well, being outside of the country and a non-resident as to additional tax implications, but we are not tax CPAs, so we can't really answer that question. We know enough to be dangerous and give you bad advice. Yeah. No, doesn't matter. We always will pre-approve people that we work with for their highest amount so that you know anything underneath that you qualify for.
And your agent may ask for an updated letter. And so we would, even though you're pre-approved at $1 million, Hao or Lan or, may ask for a letter that represents a $400,000 purchase price, and that's fine. You can update the letter as many times as you want. That's right.
Yeah, so that's one of our tactics when it comes to negotiating. So like if you are pre-approved for $1 million and you're making an offer for 920, we'll ask for an updated pre-approval for the 920, not showing that you can actually afford more and that you need help. And that's all, again, part of the negotiations. We're literally trying to get you into a home in today's market with little to like hardly any cost except for just your down payment. I mean, it's a like I said, it's a sweet thing. So yeah.
Any more questions? We'd love to do a consultation with you if you wanted to
Yeah.
give us a call. There's no obligation, but we'll help you come up with a plan A at least, and then go from there.
One other thing too on, everybody hears in the news, inflation. And there's a bunch of pillars of inflation, right? There's food, there's raw materials, there's gas, and there's real estate. And so what I like to tell people, if you're concerned about inflation, but you're renting, the cost of rent goes up with inflation annually. And I think it might be capped around 5% in some locations, but it goes up annually, where you can hedge against inflation by getting into a house, getting that fixed rate and know what your payment is every single month. The other stuff you can't control, but you can control the cost of inflation for housing.
So the question is, what's the best down payment to get the best interest rate? And that is going to entirely depend on your specific scenario, your credit score, how much you have available for down payment. Typically, it's going to be 20% down loan. That will get you the best payment because you won't have mortgage insurance.
And in some cases, 25% might have an improvement in it as
Yeah.
well with jumbo loans
Yep.
or some high balance conventional. It might have a slight interest rate improvement for it.
But if you're a veteran,
Yeah.
zero down, you might get the best rate of anyone.
Yeah, for sure.
Right. So the question is, the 10% loan that you get on an 80-10-10, is that a personal loan? And the answer is no. It's a loan against the home. It's a lien on the home. It's a second mortgage on your home that you're buying. You could, yeah. You can. I mean, not in every case. That's a little
Mhm.
stricter. I don't know if any of our HELOCs go to 95%. So I
No.
think that's tightened up.
Yeah.
Over the last few years.
10% is the highest amount of a HELOC for a piggyback loan. Piggyback loan is the 80-10-10 that Katie went over earlier. But one of the things we didn't talk about, if you're concerned with down payment, but otherwise financially ready to buy a house, you've got, good income, there is a possibility of gift money as well. You can, if you have a parent, it has to be a relative. But if you have a parent, grandparent, brother, sister, who's willing to help you with the down payment to get into a house, that's another option as well.
And I think, didn't they just change that to like a significant person in your life?
Yeah, it can be now like a fiance, whereas before you had to be married. But if we can show that relationship, either you guys been living together or whatever the case is, we have to be able to show some form of proof for that relationship.
How much is it on this? The question is, what's the interest rate on that second 10%?
So that is, again, going to depend on your credit score, and it is the rate that's going up, but I'm going to estimate that you're going to probably be somewhere between 7 and 8% on that.
So those second mortgages, those are basically a HELOC. You've probably heard the term HELOC. It stands for Home Equity Line of Credit. And that is one of the things that the Federal Reserve controls and has been raising for the last 6 months. I think it's been going up so fast. I think prime is around 4.75 right now, and the Fed's meeting the beginning of October. And chances are they're going to raise it another 3/4. So the cost of the prime rate is going up. So the cost of a HELOC mortgage, a second mortgage, is going up as well as a result.
I think you had a question there, yeah.
What's the maximum amount? Yes, without trading.
So the question is, what's the maximum amount a parent can gift to not result in a tax payment or a taxable event? So that's something you have to talk to with your accountant. We do not report that to the IRS. So you could, $1 million house, you could give them $1 million. We don't, we wouldn't do a loan then, obviously, but we don't report it to the IRS.
Yeah. But I believe the taxable amount is anything over 14,000 in 1 year. But again, consult your tax accountant.
Do you have a question? That's,
Yes.
yeah, 10% down payment, 10% equity loan.
Well, you would only take the loan out at closing. So it's a house that you would buy. Yes, it would close concurrently with the first mortgage at the closing table. Yeah.
So the question is, if you take out an equity line of credit with the same house, on the house, do you have to use the same lender? The answer is no. No. We'd like you to get, like we did the line of credit because we have all your information. I think it would make it more streamlined, but technically, legally, you don't have to.
Yeah.
For the line, is it considered refinancing for the line of credit? So if you have a first mortgage and then you get a line of credit for, let's say, down payment. So the question is, does that constitute a refinance if you just get the line of credit? And the answer is no. You're just sort of adding a second lien onto the title of your home.
Yes.
Yeah, well,
There-
the question is there an advantage to taking a line of credit on a property you own?
There could be,
Yes.
but it's more expensive for an investment property.
So I did one recently on my home that I purchased last year. Line of credits, from what I understand, is only on your primary residence now, not on any investments. So for that changed within the last year.
But I think ours will do an investment. Yeah.
So I just did one myself on a rental that I have, and it is a more expensive interest rate because it's, all mortgages are risk-based, right? So they're looking at, if you were to get in financial trouble, you're going to walk away from a rental house before you walk away from your own roof over your head. So investment property interest rates for a first mortgage are more expensive, for a second mortgage are yet again more expensive. But yes, you can take one out on an investment property. They're few and far between, and they limit the loan to value that they will go up to as well.
You have to have more equity in the house.
Yeah.
So, but if you do, you can, yeah.
Yeah.
So we do have another class coming up on November 17th. And we're going to be talking about equity and 1031 exchanges. So investment properties, if you're interested. So yeah, feel free to reach out. Thank you for all coming out tonight. And if you have any questions, We have multiple agents in the room that can help answer any further questions and even set up a time with you to meet with the lenders, talk about like your home search and so forth.
Yep. Well, thank you for coming, everyone.
Thank you.